thanks for taking some time today here. What we have is a webinar on structured income notes, and these are pretty unique investments, or something you probably haven't heard about before, as they are not fully utilized or not always utilized by financial advisors. But a couple of years ago, one of the reasons why we did go independent from a larger wirehouse was for us to be able to utilize these more and incorporate them into our clients' portfolios. So today I'll be talking a little bit about structured notes, but the main guest is Anthony Chacha, who is from iCapital, and Anthony helps us and our clients basically vet and source different structured income notes, and in order to find some of the better deals or good deals, or incorporate some of our market thesis to enhance clients' cash flows potentially. So for now, I'm going to hand it over to Anthony to talk through what these are, how they work, and then I'll take it back and discuss how to incorporate it in the portfolio, or how we incorporate it in the portfolio, as well as some next steps that you can incorporate. So I'm going to hand it off to you, Anthony, and touch a little bit about what these guys are.
Great. Thank you, Carl. Hey, everybody. Pleasure to meet you. My name is Anthony Chacha. I work at iCapital in our Private Wealth Solutions team in the Structured Investments division. I've been here for about 5 years, and I think the entire time I've been working with Carl and Petros. So we've built quite a few good structured notes together, to say the least. Really kind of, I think why Carl brought me on here today is to give a little bit of a background on what structured notes or structured investments are, how they work, and why they may be a good investment choice for you, and just talk a little bit more about the growth of the industry. So with that, structured investments have been around forever. Primarily before the 2000s, they were only available to institutional investors. In the early 2000s, they made their way into the retail space, and they have just grown in prominence since then. Here's the last 5 or so years of issuance of structured investments in the United States. You'll see there's some pretty substantial growth here. So for example, in 2018, the US market issued about $46 billion of structured investments. And at the time, that actually seemed like a lot. It was still growing pretty fast then. But now, fast forward to our last data point on here is 2023, $118 billion. So in that 5-year span, you've seen an almost doubling of the issuance. And actually, Carl, I got the numbers yesterday for 2024 issuance, just shy of $200 billion. So over a 6-year period, seeing issuance quadruple in the U.S. market, I think is a pretty good indicator for why they have become so popular and start to get more and more adopted. So with that, what is a structured investment? So essentially, a structured investment, how you want to think about it is it's a market-linked bond. So it's going to be a fixed income instrument. It's going to be issued by a bank. So say JP Morgan or Morgan Stanley, for example. But rather than getting your stated yield like a traditional bond of 4, 5, 6%, whatever it is, you're not going to receive that stated yield. Your performance is going to be tied to an underlying equity or index. And essentially, it's going to allow investors to participate in the growth of that underlying asset, or in some scenarios, collect enhanced yield based on the performance of that underlying asset. And structured investments can offer anywhere from full principal protection to partial principal protection. And the idea is we're able to help limit some of your downside equity exposure to try and achieve higher risk-adjusted returns. Now, with structured investments, the terms or the maturities can range as short as 6 months, but typically we're going to see them land in the 2 to 5 year space. Sometimes that's a fixed term, and sometimes those terms have the ability to be called early, which we'll talk about here in a moment. And like I was saying earlier, your returns are going to be subject to that underlying reference asset, index, sector, ETF, individual equity, et cetera. Awesome. So how do structured notes work? When you're looking at some of these terms, you might think to yourself, how is this possible? We don't necessarily want to go too deep into the weeds, but to give a high-level overview of what it is you're purchasing when you purchase a structured note, this is essentially the breakdown here. So on the left bar there, you're going to see the blue and the orange boxes. You have a zero coupon bond and an options package. So essentially a zero coupon bond, if you're not familiar, you're going to be purchasing that zero coupon bond at a discount to its par, and then it is going to mature in X many years' time at your full value. So in this example, you're purchasing it at 80% of its value, and fast forward, let's say 5 years, for example, it's going to mature at par. So what that means is we could take 80% of your invested principal and buy that zero coupon bond, and then we have 20% remaining. That 20% remaining principal is used to buy a stated options package. That options package is what allows the bank to create your optics. Now, whether that is upside growth, downside protection, or in the case of today's structure, an income producing note, allow you to generate enhanced yield. And as you'll see on the bar on the right there, that zero coupon will mature at par. And then hopefully, if equities perform as we expect them to, you're going to get a return above that par when your options mature. All right, so let's look at an actual example here to try and wrap our heads around, what would a hypothetical note look like and how would those returns be structured. So there's a little bit of moving pieces here, so stick with me, but I'll try and give a good explanation, and then we'll go through some examples to really hammer home how all the features work here. So with this note, it'd be issued by a particular bank. This example doesn't have one, but pick any major bank, JP Morgan, Morgan Stanley, whoever, and it's going to be linked to a few different underlying index. So you'll see on the left here, thank you, Carl, that your underliers are going to be the NASDAQ, the Russell, and the S&P 500. And you'll see above there it says lesser of. So essentially, over the entire term of this note, we're going to be monitoring those three indices, and your performance is going to be tied to the lesser performing of those three, and it'll make sense in a second why. So the term on this, it's a 3-year note, so the longest that you can be in this trade is 3 months, but it also has a call feature. So you'll see there it says non-callable for 6 months, so you can't get called out in the first 6 months, but at the 6-month marker and every quarter afterwards, it is eligible to be called out. Now, what does it mean when your structured note is called out? Well, if your underlying indices are flat or positive from where you purchased them, you're going to be called. You're going to be given any of the coupon or interest you've made along the way, and your principal is going to be returned to you. And essentially, this is an additional liquidity option where you can either, take those funds and allocate them elsewhere, or as you, Carl DePetros, you decide, allocate to a new structured note. Now, in terms of how are you going to get paid this yield? So your coupon rate here is 8%, and it's paid quarterly. So 8% per annum or 2% per quarter. Now, how are we able to achieve that 8% yield? backed on an investment grade credit like JP Morgan, well, that yield is contingent. It's not a guaranteed yield. So you'll see there's a contingent coupon of 8%, and the contingency is that your underlier is greater than or equal to 70% of your initial value. So when you purchase this note, if the reference assets were trading at $100, as long as they don't decline by more than 30% on each quarter, you're going to get paid a 2% cash distribution each quarter. In the event where one or all of them are down more than negative 30%, think, a massive market sell-off, then your income stream will be put on pause until the market recovers above that 70% of where you started, or a negative 30 decline. All right, perfect. So let's go on to a hypothetical. And before I go on to it, really what's the idea with one of these income notes is how can we achieve an 8% per annum yield or total return when the market's up, sideways, or down as far as negative 30%? Or another way of looking at negative 30 for clarity is 70% of your starting value. So in this example here, we're going to look at a scenario where the S&P 500 declined over a 3-year period. You'll see in quarter one of the graph here that the S&P started at $1,000. Each quarter, the S&P value has declined. In Q2, the S&P is down $50. It's trading at 95% of where you bought it. You're still going to collect your 2% coupon in that period. And every single period where the S&P is declining, as long as it's above that red line, you're going to be receiving a 2% coupon each quarter. Again, that's paid out as a T+3 cash distribution. So again, the red line, that's your coupon barrier of 70% of where you started. So anytime you're above that threshold, you're going to get paid. If we go to year 3, quarter 2, you'll see the red bar there. So if the S&P from where you bought it 2.5 years prior fell by more than 30%, so in this case, it's down just a hair more than 30%, well, what happens? You do not get your coupon for that quarter. So that 2% payment is skipped. But you'll see in this example, and what we'll see a lot of times in bear markets that are down as far as 30%, it quickly rebounded in this hypothetical. And in Q3, you're back above that 70% threshold. You started to collect your coupons again. So even though the S&P was drastically negative over this entire 3-year period, only missed one coupon of 2%. So you received a total of 22% of total coupons over that time frame. You're going to receive, and your annualized total return is about 7.33%. Now, your principal here, as long as at maturity, your reference underliers are above that red line of $700 or negative 30%, you're going to get your whole principal back. In this scenario, the S&P finished at about 80% of its initial value. And so therefore, you receive your coupons and 100% of your principal was returned to you at maturity. Awesome. All right, scenario 2. We have another market that's slightly down, but it recovers and we end up positive at the end of 1 year. So what happens in this scenario? So in year 1, for those 1, 2, 3, and 4, you see a slight decline and the S&P is a little bit choppy, but you're well above that 30% threshold where you'll miss a coupon. So you get 2% paid out each quarter. On Q1 of year 2, the S&P is actually positive. So it's above where you purchased it. In that example, if you remember, when the underliers are above your purchase price, the note gets called out and your principal is returned. So in this scenario, you get your final 2% payment and you get your principal returned back to you early. So in this scenario, your total return was 8% per annum or 10% of total coupons, and you're exiting the trade early with your full principal. You could take those funds and reallocate them into a different investment, Or if you liked the idea of the structured note and it worked out well for you, Carl would just reissue a new note for you. Awesome. All right, so scenario 3 looks a little bit like scenario 1 here, but maybe the market didn't recover as we were hoping it would. So in this scenario, in years 1 and 2, we can kind of fast forward through them. You'll see the S&P 500 in those first 2 years is declining, but in every quarter through year 1 and year 2, that blue line is above the red line there of your 30% coupon protection. So you've received every coupon along the way, even though the S&P is declining. Year 3, quarter 1, you're still above your red line. You're going to receive a 2% threshold. But as you'll see there, for quarters 2, 3, and 4, the S&P is below your coupon payment threshold of -30 or 70%. In those 3 quarters there, because you're below, you're not going to receive the coupon for any quarter where you're below your coupon payment threshold. So in that case, these 3 are not going to be paid out. And then in addition, because at maturity, your underlier is below that 30% protection barrier, or in this case, it's 660, and it's below that $700 threshold, you are going to participate in the losses of the S&P 500 1-to-1. So the S&P is down at $660. You're going to take on a principal loss of 34%. Now, obviously, nobody likes to see a principal loss of 34%, but you have to remember, if you were sitting in the S&P 500 anyways, it would be the same principal loss. You're not accelerating any losses here. And because of the coupons that you've received along the way, you received about 18% of coupons along the way. The total return is down only 16% on the total investment, or 5.33% annualized. So in this investment, those coupons essentially helps to buffer your losses. And instead of actually total investment losing 34%, like you would have sitting in the S&P 500, you're only down 16%. So actually less than half of the losses of sitting in the S&P 500. So although this isn't the optimal scenario, it's still a much better outcome than just sitting in the market.
Awesome. Well, thank you, Anthony. And so just to kind of recap the scenarios that Anthony went through, if the stock market keeps going up, not a problem. You have that enhanced yield. If we start to get that choppiness, that actually tends to get us that yield for longer. And it's really some of those long, drawn-out portfolio drops where the performance can be a negative or can be a negative return. And so these are a great portion, or where this fits in the portfolio tends to be right in between that stock and bond allocation. And so this is great to utilize for if you were to have a bunch of wealth received either from a sale of a home, a business, inheritance, and you want to try to walk into the market just in case you buy in and the stock market drops right away. This could potentially have that enhanced yield where when that coupon is paid, then you can start using that cash that you got from this yield note and you can go ahead and reinvest it into equities to start to build out the rest of the portfolio. So this is great for, again, walking into the markets, having that downside protection. And then for folks that maybe are retired and they want to have some additional yield without touching their principal, it's also a great tool for them as well. And so I'll cover this in some reasons why here in a little bit, but generally we want to keep structured notes anywhere between a 10 and 20% of a client's portfolio. This is just a made-up example where we have a little bit more because of that influx of cash, and we're trying to slowly build out, their strategic allocation of maybe 70% stocks and 30% bonds might be the target we're shooting for. But in the meantime, we're walking things in. and versus just sitting in cash, which money markets paying about 4.25% or so. And if the Federal Reserve lowers rates, then we'll keep getting lower yields from that. And if you compare that to traditional bonds, you might get 5, maybe 5.5 or so on that front. This is something where you can add to that yield in that fixed income space. So it's a great diversifier and complement to the rest of the portfolio. But even if somebody says, "Yep, that's a great return, 8% a year," let's just do all that. Here at Petros, we say, nope, don't do that. And the reason is there's, like anything in life, there's always risks or trade-offs. So I was going to cover a couple of those. But by far the biggest risk of structured notes, similar to the risks of traditional bonds, is that since we are lending money to a bank, even if the underlying investments might be positive, there's a potential if that bank fails, goes bankrupt, we could potentially lose all of our funds in that investment. And so that's by far the biggest risk, and why I'll show you, what we do to mitigate those risks. That's number one. Number two is statement or liquidity risk. So one of the trade-offs for the enhanced yield is that when we buy one of these, we can sell them at any time. However, we don't get the full benefits of the hedges if we sell it early. So that's what's called statement risk or liquidity risk. Even though it's a growing industry, like Anthony shared earlier in the presentation, when we buy these, there's not a lot of folks buying them on a secondary market. So if, for example, the underlying investments are positive, and if we just held on, we would get all of our principal back plus those coupons. If we want to sell it early, then we might have to sell it for 98 cents on the dollar or 95 cents on the dollar. And if the underlying investments are really struggling, you can see here on the right is just an example, hypothetical here, where if we hold it to maturity, no problem, didn't lose any funds, get all your money back, 100% back, plus those coupons. But if we wanted to sell a little early, then we have to sell it at 85 cents on the dollar. And so that's one of the trade-offs where even if we love that income and that risk return profile, in case you need access to cash for your family or for a big purchase or something, that's why we'll have the traditional stock bond allocation as well. That's much more liquid, and that we don't have to give up some of that internal premium. So as far as how our philosophy to be able to incorporate the good with the bad, number one, we want to customize it to the client's needs. So let's say, for example, a client has a taxable account and they are looking to buy a home or a cabin in 3 to 5 years. Well, for that account that we're saving and investing, we likely won't incorporate as much structured notes into that portfolio because we might need access to that in 2 years. And if we have a 3-year investment structured note, it does put it at risk as far as the potential to have to sell it early and at a loss or at a discount to its internal value. And so for that type of client, you might have less structured notes or no structured notes. But for like a retirement account that we might not have to touch for many, many years, that might be a better fit for that client's portfolio. The other thing, so we just covered using traditional stock market indices. And those are great because you can have the stress tests and back testing different risk levels. But you can also incorporate this for individual stocks. So if somebody wants to incorporate an individual stock in their portfolio, but they think that the run-up's been a little bit too much, we can create a structured note, either a growth one or an income one, off that specific stock. And the individual stock structured notes tend to be a little more risky just because of the possibilities of market fluctuations are more than a broad-based index. So just got to be careful of that. But the key is whatever we put together for a client, that's going to be customized to their need. The other piece that we like to incorporate, because there's that liquidity risk, what we want to do, even if a client says, yep, let's go ahead and do this, generally we take 3 to 6 months to slowly build out those structured notes. And what that does is, fast forward in 2-3 years, we're going to have structured notes fully mature and go to cash, either be the growth or the income. And what that does is that reduces that liquidity risk, because if you always have structured notes maturing and laddered together over time, if a client needs cash, well, we might have a structured note maturing here next week, and we don't need to sell it early in order to provide that liquidity need. So, so as far as we're building things out, our philosophy is to do it over the course of many months to build that strategic allocation. That also allows us to mitigate that, remember that number one risk, the credit risk, that allows us to buy from different banks at different times. So it could be Citigroup, RBC, Goldman Sachs, and if we have multiple banks in a client's portfolio of structured notes, that also reduces the credit risk because we're exposing ourselves to different creditors. Last thing too, these structured notes tend to do best when interest rates are high and when volatility is high, and so so things can, the terms can be very, very attractive, particularly when we have higher volatile times like we did, for example, a month ago during the tariffs. Those are very, very attractive, and so if we're building out a structured note portfolio or as a portion of a client's portfolio, some of those volatility spikes tend to happen once or twice a year, and we want to jump on those to try to lock in some of those additional income for the client. So that's why we keep it to 10-20%, sometimes a little bit more if we're walking in, into a strategic allocation. But it's a great complement to a traditional portfolio and enhance that yield or enhance that income to meet the client's cash flow goals. And so if you want to learn more, you want to take a look, feel free to shoot an email to me, give me a ring, or you can set up a meeting here through Calendly. And then we got plenty of videos out there on YouTube, and so we got cheesy little thumbnails down there. And but feel free to take a look. There's a whole playlist about structured notes as well as some other topics. So hope you can enjoy it. But I think with that, unless there's any questions, I think we'll probably wrap up for today. So so appreciate you taking some time. Again, hope to follow up with you soon. Thanks so much.